The Breakwave Tanker Shipping ETF, ticker BWET, is a very different kind of ETF and one that many investors have never encountered before. BWET provides exposure to the crude oil tanker shipping market, which sits at the intersection of global energy flows, geopolitics, and commodity logistics. BWET is the first ETF designed specifically to track oil tanker shipping rates. Rather than owning shipping company stocks, the fund provides long-only exposure to freight rates by holding near-dated wet freight futures contracts. These contracts reflect the cost to charter oil tankers to transport crude oil along specific global routes. The ETF tracks an index made up of freight futures tied to two major tanker categories. 90% of the portfolio is allocated to VLCC contracts, which stand for Very Large Crude Carriers. These are the largest oil tankers in the world and are used to move massive volumes of crude across long distances. The remaining 10% is allocated to Suezmax contracts, which represent slightly smaller tankers that can navigate more constrained shipping routes. The portfolio has a relatively short average maturity, typically around 50 to 70 days. That means the fund is constantly rolling futures contracts to maintain exposure to current freight rates. This structure allows BWET to respond quickly to changes in tanker demand, supply disruptions, and shifts in global oil trade flows. Oil tanker shipping plays a critical role in the global commodity market and has historically shown low correlation to traditional asset classes like stocks and bonds. Freight rates are influenced by factors such as oil production levels, refinery demand, geopolitical tensions, sanctions, shipping bottlenecks, and even seasonal trends in energy consumption. Because of this, BWE is often viewed as a potential diversification tool rather than a core holding. If you're finding this breakdown helpful, make sure to like the video and subscribe to the channel. We focus on breaking down niche ETFs like this, so you understand exactly what you own. One important thing to understand about BWET is that futures-based exposure is not the same as owning the underlying asset. Freight futures are an imperfect proxy for spot shipping rates, and the market structure matters. The freight futures market is often in contango, meaning longer-dated contracts trade at higher prices than near-dated contracts. When the fund rolls its positions forward, this can create a drag on returns over time, commonly referred to as position decay. Because of this, BWET is not designed to be a long-term buy-and-hold investment. It is better suited for tactical or opportunistic exposure when tanker markets are tight, freight rates are rising, or geopolitical events disrupt global shipping patterns. Holding BWET for extended periods during weak freight environments can lead to underperformance due to roll costs. Another key consideration is taxes. BWET is structured as a commodities pool, which means investors will receive a K-1 at tax time. Additionally, gains can be taxable even if you do not sell shares. This structure adds complexity and may not be suitable for all investors, particularly in taxable accounts. The fund uses a fixed weighting scheme that is rebalanced annually. This approach keeps exposure consistent across tanker categories, but does not dynamically adjust weights based on market conditions. As a result, performance is heavily tied to the underlying freight rate environment, rather than active management decisions. From a portfolio perspective, BWET is best viewed strictly as a diversification tool. It is not a complete investment program and should not replace traditional equity or bond allocations. Instead, it may appeal to investors looking for exposure to global energy logistics, shipping cycles, or uncorrelated return streams. Before investing, it is important to understand that BWET combines commodity risk, futures risk, and tax complexity. These factors can create periods of strong performance, but they can also lead to sharp drawdowns and uneven long-term returns. Before you go, let me know in the comments what you think about tanker shipping as an investment. Do you view it as a smart diversification play or too complex to justify? If you found this video useful, make sure to like it and subscribe for more ETF breakdowns and market structure insights. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions.